Money in Motion video blog. This is Dan Perkins, and today I want to talk about two things. First, the new quantitative easing from the Federal Reserve, which was announced a couple of weeks ago, and second, some observations of my most recent trip to Europe and what I saw there. So let's get started with QE2. I have to tell you, I'm at a loss to try and figure out how the Fed, by purchasing mortgage-backed securities, is going to create jobs. The Fed currently has two mandates. One, to control inflation, which it's certainly doing. And two, its responsibility is to try and make the economy grow and create jobs. Now, the Fed doesn't do the hiring, but the Fed puts policies in place that perhaps allow businesses to expand and new ones to be formed. However, if you understand that the Fed is going to buy $40 billion of mortgage-backed securities, their intention, apparently, is to try and drive down mortgage interest rates, which creates an opportunity for people to buy and for people to refinance. That doesn't create jobs. It simply rechannels money. Those mortgage-backed securities are being bought from investors like us, who own Ginnie Mae's and Fannie and Freddie conventional mortgages. And if they buy them away from us, we're going to turn around and just buy more. So we're not going to make a fundamental decision to move our money out of the mortgage-backed securities market because the Fed is buying $40 billion a month. So I don't see how buying mortgages creates jobs. Not nearly the magnitude of jobs that we need in order to get this economy to turn around. If you think about, we have a stated unemployment rate of 8.1% and an implied unemployment rate of probably closer to 11%. In some segments of our economy, we have devastating unemployment. Black youth, for example, the unemployment rate is over 50%. Adult black males, the unemployment rate is over 14%, virtually unchanged during the Obama administration. So I think the Fed is ill-advised to do a QE3 buying mortgage-backed securities. If we look at the previous two, quantitative easing 2 and 1, one was done because of the significant meltdown in the credit markets and the economy in 2007 and 8 and early 2009. The second one, again, was buying mortgage-backed securities, but you saw that there was no significant job growth. And the number of people off the work rolls has actually increased from where it was at the beginning of the Obama administration in January of 2009. So we have less people working. Buying mortgage bond securities, to me, doesn't seem to be a way to create new jobs in our economy. Also, the Fed at that meeting, which I felt was very important, announced that they were going to keep their zero interest rate policy on board probably until the middle of 2015. Later, after the meeting, one of the Fed governors said perhaps at the next meeting they should tell the capital markets that they intend to keep interest rates low until the unemployment rate drops to 5.5%. Now, I don't know what that means in terms of, is it the real number or is it the phony baloney number that the government produces by taking people off the rolls once their benefits have run out. In either case, it could be a long time. The significance of this particular announcement is that we have now approaching 4 years of zero rate of return on cash equivalent returns. And based on the Fed announcement, we're looking at 3 more years of earning virtually zero. And when you adjust it even for a modest inflation rate of 2% or less, you're losing money. We have a potential here of having somewhere between 7 and 10 years of cash returns producing zero. The markets, which have reacted previously to quantitative easing, the initial reactions were not favorable. The pundits were predicting that if the Fed would announce a QE3, that we would see a rise in commodity prices, including oil and copper, and interest rates would fall. In fact, the opposite happened. Oil prices fell to around 90, and the yield on the 30-year Treasury went above 3% for the first time in a significant period of time. Over the last few days, it's dropped back to its support level of 285. But I think that that's because the market believes that the economy is in worse shape and that the Fed's quantitative easing won't do anything to change the basic fundamental outlook on the economy. So we have people, retirees, the wonderful statistic that I saw, 10,000 Americans a day started retiring this year and will continue to retire for the next 19 years, 10,000 people a day. And these are people that have retirement funds who have to depend on that to provide for them in retirement. I hear story after story of a person near or in retirement using money market funds and certificates of deposits to supplement their Social Security or their pension income. And now with zero rate of return, what you have is a situation where in order to maintain their standard of living, people are starting to liquidate assets. That's a serious, serious problem. Other short-term rates are also indicating a significant contraction in the economy. 90-day LIBOR, which was trading at almost 52 basis points to 57 basis points, has fallen dramatically in the last few weeks down to 36 basis points, the level it was a year ago. 90-day LIBOR is a basis for a lot of loans, as is one-month LIBOR, which has also dropped to a new low over the last 12 months. Excuse me. So the markets are telling us that they're not convinced that the economy is going to turn around. I think one of the most interesting indicators of that was the recent announcement by Federal Express that they expect to see significant contraction and recession on a global basis in 2013. And they're making announcements that their earnings are going to be down. Global recession is a possibility. I think that what I saw in my recent trip to the Danube River area in Germany, Austria, Czech Republic, Slovakia, and Hungary is that wide divergence. For example, in Germany, down in the southern part of the country, unemployment rates 3.5%, in some cities as low as 1.5%. Yet, if you go to the Czech Republic on the other side, or you go to Hungary on the other side of Germany, and you're seeing unemployment rates in the 30%. What I found on my trip was that a lot of people were concerned about the direction of the U.S. economy, both with the people on the trip and people in the local economy. They look for us as to guidance as to how things are going to go, and that we're such a huge part of the world economy. Any significant contraction in us, if we get a cold, the rest of the world gets pneumonia. So I think that the economy is going to slow. The markets have done extremely well. Corporations are sitting on enormous amounts of cash. I still believe we're going to continue to see volatility in the equity markets. Depending upon how the debates go, you may see some wide swings in volatility in the markets. So keep your eye on the days after the debates and see what happens to the rhetoric. Going to be an interesting time over the next 30 to 60 days. And we are at probably a crossroads in our history. Never before in the times that I've been voting for president have I ever seen such a significant contrast in the vision of America. One is a more government-involved, more socialist model, and the other is a free enterprise model. My recent trip to Europe shows me that the socialist model didn't work. We may be able to do it better than the Europeans. I don't know, but I'm not sure I want to take the risk. So make sure you vote. And by the way, thank you for having some people call me. I'm happy to help people, friends and relatives who need help. So if you have friends or relatives who are concerned about their money and what's going on, feel free to give them my name and number. And if you have questions, make sure that you send me an email or give me a call, and I'll do my best to answer them. Thank you and have a good day.